All right, hello everyone. Thanks for tuning in. I'm Mark, the stock market jobber, and I want to talk about why I think the market's going to continue to go lower. And if you've been following us, uh, you would have known that pretty much we saw this sell off coming, and all you got to do is just check out our videos from like a week or two ago, and you'll notice all kinds of bears on the cover. So if I put a bear on the cover, I think the market's going down. If I put a bull on the cover or on the whatever you call it, the thumbnail or whatever, I think the market's going higher. But anyway, here is why I think the market is going to continue to go lower. I'm just seeing some negative action. Now, first of all, let's go talk about the 10-year yields, right? There was this kind of this stupid narrative that, oh, gee, the market's going to go higher because the Fed's going to pivot and start cutting rates. I don't know how anyone can believe that. I mean, it's like we have all this inflationary data, stuff is coming in higher than estimated. Um, and look at this here. These are 10-year yields, okay? These aren't politicians. They don't lie. They're not wrong, right? We got a lot of politicians that lie and are wrong, but the market never lies. Yields are basically higher than they've been in the last 13 years. So this is negative for the market. Why are higher interest rates negative for a market? Well, first of all, the vast majority of companies, they don't take money out of the register to pay their employees. They borrow money in these overnight or short-term lending agreements. We call it commercial paper, this, that, the other. It doesn't matter. The bottom line is this. Companies need to borrow money, and if the interest rates are higher, it costs more to borrow the money, and that takes profit right out of the bottom line. So that's one reason why higher interest rates are bad. Another reason are bad for equities. Another reason is if interest rates keep coming higher or going higher, well, all of a sudden the bond market starts to look more appealing than the stock market. If the stock market is down 10% and you can go get a 4% yield in a bond, well, what are you going to do? Another reason is that a lot of these big funds use leverage, and if interest rates go up, that leverage costs more because all leverage is them borrowing money from somewhere else to hopefully increase their returns. For example, if you manage $10 million and you have a 2% return, that's $2 million. If someone gives you $10 million worth of leverage and you have a 2% return, that's $4 million. So you would have doubled your returns, and you could just give the money back with just small fees or whatever. So anyway, so there is a definite reason why higher yields are bad for markets. Now, here we have the healthcare sector, which is the second biggest sector in the market. Now, you don't need to be a chart guru or a former hedge fund trader or a former market maker like I was to see that, man, this thing is just kind of starting to fall apart here. And this is pretty much, it's healthcare. This is considered a safe sector. When you start seeing the really safe stocks start to blow up, it's one thing to see the Reddit stocks blow up. It's another thing to see healthcare stocks start to fall apart. So this is not good either. This is some negative action. So we got interest rates moving higher. We got healthcare selling off, the second biggest sector in the market, which is allegedly safe. Now, a big part of the recent move higher since the beginning of the year has been Apple. Apple is the biggest stock in the market. It's got the greatest market cap. Apple, I think, is about maybe 5% of the S&P 500. So one stock makes up 5% of 500 stocks. Anyway, it was trending higher. It failed that resistance and it broke support. At Stock Market Jobber, we talk about levels, trends, and support. We don't waste our time on funny things like Elliott wave and Fibonacci. Levels, trends, and momentum. And when we look at a chart, we're looking at an illustration of supply and demand and market psychology. All right. So anyway, the blue team was in charge. We're going higher. We're going higher. We're going higher. All of a sudden, guess what? We stopped going higher. Now, what's the first thing something needs to do before it goes down? Well, it's got to stop going higher. And if you notice, we went sideways for a few weeks and then we crossed this trend line. Now, this trend line is not a support or resistance level is just a kind of a graphical illustration that lets us know, man, maybe things are turning here. After a while, you're not even going to need to put trend lines on your charts. We'll just be able to see it. But, I think where you're at now, if you're just starting off, I think it's a good idea. So anyway, so we got healthcare melting down. We got interest rates going higher. We got some negative action in the biggest stock in the market. Now here's Berkshire Hathaway, right? It's not as big of a company as Apple is, but it's the biggest company in the financial sector. And we can see we're right down back to this resistance level. I mean, sorry, support level. So why is there support around 300? Well, there are people who sold it here who thought they made the right decision, but once it went higher, a lot of these people told themselves, man, I made a mistake. I'm going to buy my shares back, but I'm only going to do so if I can get them for the same price I sold them at. So we have remorseful sellers placing buy orders at the level that was resistance. If there's enough of them, enough of these buy orders, the level converts from resistance into support, and that's what we see here. Over the last 4 days, we've been testing this $300 level. If this starts to give way, I mean, the broader markets are going to really start to move lower. Now, I think it does. Why? I mean, I'm not saying it breaks it on Monday or Tuesday, but I think ultimately it does because we have this pattern here. We could almost call this a descending triangle. And what this tells us is that when we have these lower highs, it means that as time goes by, sellers are willing to accept lower prices. They become more aggressive. The buyers, meanwhile, just kind of hang out around 300 and let the sellers come to them. So you got buyers that are kind of just chill and waiting for sellers to come to them, but you got sellers that are getting really antsy and anxious. So any market where you have aggressive sellers or anxious sellers, but kind of chill, complacent buyers, it sets the stage for a move lower. Righty. So last but not least here, people got all hyped up about Nvidia, and to be honest with you, the earnings were terrible. Their net income was down 50%. Their numbers were terrible. So I think this is just a little bit of market euphoria. People hear like, oh, AI, 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 blah, 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 AI. Yeah, whatever, dude. AI is not, I'm sick of AI, whatever. People have been talking about it for 70 years now. It comes in vogue, it goes out of vogue, whatever. The company is getting massacred. Their earnings are down by 50%. So my guess is that this particular stock that led any kind of strength we had over the last few days is going to break back down here and go lower. All right, that's it, everybody. That's my 5 reasons why I think the market goes lower. And if you don't believe me, I've been saying this for a while. Just subscribe to our YouTube page and check out all the videos that I had last week with the bears on the cover. And, that's a good sign. So thanks, everybody. I will talk to you soon.